Right now, while you're watching this, someone else is making money from the exact mistake you just made. Not because they're smarter, not because they have secret indicators, but because they don't trade like an emotional animal. They wait. You chase. They plan. You react. And every impulsive click you make feeds the disciplined trader on the other side of your trade. If you keep trading without control, without patience, without rules, you're not building wealth, you're funding someone else's lifestyle. Today, that ends. Most traders begin their journey believing that their biggest obstacle is strategy. They assume they simply haven't discovered the right indicator, the perfect combination of confirmations, or the hidden system that professional traders secretly use. So they search. They watch endless videos, buy new courses, download different indicators, and redesign their charts repeatedly. Every new strategy feels like a fresh start. It brings excitement and renewed hope. For a few days or weeks, they follow it with confidence. But eventually, the same pattern appears, losses come, discipline fades, doubt grows, and the search begins again. What most traders fail to realize is that consistent failure is rarely caused by a lack of technical knowledge. More often, it is caused by inconsistent behavior. The strategy changes, but the behavior stays the same. There is a powerful difference between having a plan and following a plan. Many traders can clearly explain their entry rules, stop-loss placement, and profit targets before entering a trade. On paper, everything makes sense. But once real money is involved, emotions quietly take control. Fear, greed, impatience, and ego begin influencing decisions. A trader might hesitate when the setup appears because the last trade was a loss, or they might jump into a trade early because they are afraid of missing out. Sometimes they move their stop-loss further away to avoid taking a loss, convincing themselves that the market will turn around. Other times, they close trades too early because they fear losing unrealized profit. In each case, the plan exists, but it is not being followed. Emotional decision-making is powerful enough to destroy even a profitable system. A strategy can have positive expectancy over 100 trades, but if a trader interferes with it emotionally after just 3 losses, the statistical edge disappears. Consistency is what allows probability to work. Without consistency, even the best system becomes random. Profitable trading is not about predicting every move in the market. It is about executing a defined process repeatedly while accepting uncertainty. The market is uncertain by nature. No setup guarantees success. There will always be losing trades. The goal is not to avoid losses completely. The goal is to manage them properly while allowing winners to outweigh them over time. Destructive emotional patterns often develop slowly and feel logical in the moment. Overtrading is one of the most common. A trader feels that being active means being productive. If they are not in a trade, they feel like they are missing opportunity. This leads to taking low-quality setups that do not meet their criteria. Revenge trading usually appears after a loss. Instead of calmly accepting the outcome, the trader feels a strong urge to win it back. The focus shifts from following the plan to recovering money quickly. This emotional urgency often leads to larger position sizes and impulsive entries, increasing risk dramatically. Moving stop losses is another dangerous habit. When price approaches the stop, fear activates. Instead of accepting the predefined risk, the trader moves the stop further away to avoid being wrong. In the moment, it feels like giving the trade more room. In reality, it destroys risk management and increases potential damage. Closing trades too early is driven by fear as well. A small unrealized profit feels fragile. The trader worries that the market will reverse, so they exit before reaching their planned target. Over time, this behavior reduces the average reward while losses remain consistent, damaging the overall expectancy of the system. Risking too much after a win is equally harmful. After a profitable trade, confidence rises. That confidence can quickly turn into overconfidence. The trader increases position size without proper reasoning, exposing the account to unnecessary risk. These behaviors are driven by emotional triggers. Fear of missing out pushes traders into trades that do not meet their standards. Fear of losing causes hesitation or premature exits. Greed after small wins encourages excessive risk-taking. Ego after losses makes traders attempt to prove themselves right instead of protecting capital. Each emotion feels rational in the moment because it is tied to immediate relief. Closing a trade early removes anxiety. Moving a stop reduces the pain of being wrong. Entering quickly satisfies the fear of missing opportunity. But while these actions reduce short-term discomfort, they create long-term instability. The market does not reward intelligence, strong opinions, or hard work alone. It does not care how confident someone feels about a direction. It does not adjust based on effort or intention. The market rewards discipline and risk management. Success in trading is less about being right on individual trades and more about managing risk consistently over a large sample size. Every strategy operates within probability. No system wins 100% of the time. Losses are not signs of failure, they are part of the statistical process. Professional traders understand this deeply. They do not judge their ability based on one trade or one day. They focus on expectancy, the average outcome over many trades. Expectancy is built on consistent execution. If a trader follows their rules across 50 or 100 trades, the edge has space to appear. But if they constantly change rules, skip valid setups, double risk impulsively, or interfere emotionally, the results become unpredictable. The problem then seems like strategy, but in reality, it is behavior. Intelligence can help design a system, but discipline is required to execute it. Many traders overestimate the importance of analysis and underestimate the importance of emotional control. Charts are studied for hours, but mindset is ignored. Indicators are optimized, but habits are not examined. Understanding this shift changes everything. Instead of searching endlessly for better tools, the trader begins examining their reactions. Instead of asking, "What new strategy should I try?" they begin asking, "Did I follow my rules today?" Instead of blaming the market, they review their own execution. This shift from external focus to internal responsibility is uncomfortable, but it is powerful. When behavior becomes the focus, improvement becomes measurable. Discipline can be trained. Risk limits can be enforced. Journaling can reveal emotional patterns. Self-awareness can reduce impulsive decisions. The illusion is that strategy is the solution. The reality is that behavior determines the outcome. A simple system executed consistently often outperforms a complex system executed emotionally. The market is not conquered by prediction. It is navigated through control. When a trader truly understands that their behavior under pressure is the real challenge, their priorities change. They stop chasing perfection and start building stability. They accept uncertainty instead of fighting it. They focus on process instead of individual results. And once this realization takes root, it becomes clear that if behavior is the real problem, then discipline must be the real solution. Professional trading is not defined by how much money someone makes in a single day. It is defined by structure, consistency, and risk control. Many traders imagine professionals as people who predict markets perfectly or take large positions with confidence. In reality, professional trading is built on rules that reduce emotional decision-making. A professional approach always includes clear entry criteria, clear exit criteria, fixed risk per trade, maximum daily loss limits, and defined trading sessions. These elements create boundaries. Without boundaries, trading becomes reactive and impulsive. Clear entry criteria mean that a trade is only taken when specific conditions are met. This removes guesswork. Instead of entering because it looks good, the trader waits for predefined confirmations. Clear exit criteria are equally important. Before entering a trade, the stop loss and target must already be defined. This prevents emotional decision-making after the trade is live. Fixed risk per trade ensures that no single position can significantly damage the account. Maximum daily loss limits protect traders from emotional spirals. If a trader reaches that limit, they stop for the day. Defined trading sessions create focus and discipline. Professionals do not trade all day randomly. They operate during specific hours when their strategy performs best. The difference between casual trading and structured trading is mindset and control. Casual traders react to market movements. They take trades because they feel opportunity. They adjust position sizes based on confidence. They continue trading even after emotional losses. Structured traders operate like business owners. They follow a plan regardless of mood. They measure performance over weeks and months, not hours. Casual trading is driven by excitement and short-term results. Structured trading is driven by consistency and long-term sustainability. Risk management is the foundation of professionalism. Profit comes second. Most beginners reverse this order. They focus on how much they can make instead of how much they can lose. This mindset creates instability. A professional trader asks one question before every trade: how much am I willing to risk? A common rule is risking 1% or less of total capital per trade. This ensures survival during losing streaks. Even 5 consecutive losses would reduce the account by only 5%, which is manageable. Large risk per trade, on the other hand, creates emotional pressure and increases the chance of significant drawdown. Another key rule is never increasing risk to recover losses. After losing trades, emotions push traders to win it back. This often leads to doubling position size or entering lower quality setups. While it may occasionally work, it destroys long-term stability. Recovery through aggression is gambling. Recovery through discipline is professional behavior. Risk must remain consistent regardless of recent outcomes. Understanding risk to reward ratios is essential. Risk to reward compares how much is being risked to how much is being targeted. For example, risking 100 to make 200 creates a 1-to-2 ratio. This ratio allows profitability even with moderate win rates. If a trader wins only 50% of trades but maintains a 1-to-2 risk to reward ratio, the math works in their favor. Over 10 trades, 5 losses at 100 each equal 500. 5 wins at 200 each equals 1,000. The net result is 500. This example demonstrates that profitability is mathematical, not emotional. It does not require being right all the time. It requires consistency in risk and reward structure. Compounding reinforces this principle. Slow, consistent growth builds accounts steadily over time. Aggressive gambling may create occasional large gains, but it often leads to large losses that erase progress. Professional traders understand that long-term growth comes from protecting capital first. A steady 3–5% monthly return compounded over years can outperform sporadic high-risk gains. Compounding works best when volatility in returns is controlled. Stability accelerates growth more reliably than short bursts of aggression. Creating a repeatable trading process turns these principles into daily action. A structured process reduces emotional interference because it provides clarity at every step. The first stage is pre-market analysis. This involves reviewing higher timeframes, identifying key levels, and understanding overall market context. Preparation builds confidence and reduces impulsive decisions. The next step is identifying high-probability zones where the predefined setup is most likely to occur. This narrows focus and prevents random entries. After identifying zones, the trader waits for confirmation. Patience is critical. Entering too early increases risk and reduces probability. Confirmation rules must be specific and measurable. Once confirmation appears, execution should be decisive and without hesitation. Doubt and delay often result from lack of preparation. When the process is clear, execution becomes mechanical rather than emotional. After entry, the outcome must be accepted. The stop loss and target were defined beforehand, so there is no need for interference. Watching every tick creates anxiety and temptation to adjust trades unnecessarily. Professionals trust their plan and allow probability to unfold. Whether the trade results in a win or loss, the next step is journaling. Recording the setup, reasoning, emotional state, and adherence to rules provides valuable feedback. Over time, patterns become visible. Strengths can be reinforced, and weaknesses can be corrected. The most important principle in this entire framework is repetition. The goal is not to win every trade. The goal is to execute the same way every time. Consistency allows statistical edge to manifest. Without consistency, even a strong strategy fails. Professional trading is not about excitement or prediction. It is about building a system that can be followed under pressure. When structure replaces impulse and risk management becomes the priority, trading transforms from emotional guessing into controlled execution. Developing discipline and emotional control is the turning point where a trader moves from inconsistency to stability. Most traders understand strategy, risk, reward, and technical concepts, yet they still struggle because emotions interfere at critical moments. The market constantly triggers fear, greed, impatience, and ego. Without emotional control, even the strongest framework collapses. Discipline is not something that appears automatically with experience. It is something that must be trained intentionally. One of the most powerful mindset shifts in trading is learning to detach from individual trades. Each trade is not a verdict on your skill, intelligence, or potential. It is simply one sample in a large statistical series. When traders attach too much importance to a single outcome, they amplify emotional reactions. A winning trade creates excitement and overconfidence. A losing trade creates frustration and doubt. This emotional fluctuation leads to inconsistent decision-making. When you begin to see each trade as just one data point among many, the pressure decreases. Professional traders think in batches, not moments. Instead of evaluating performance after one trade, they think in terms of 20 to 50 trades. Over that sample size, probability becomes meaningful. A single loss within 30 trades is irrelevant. Even 5 losses in a row may still fit within the expected variance of a profitable system. This perspective reduces emotional attachment. The focus shifts from, "Did I win this trade?" to, "Did I execute my plan correctly?" That subtle shift transforms trading from an emotional activity into a process-driven business. Emotional attachment increases mistakes because it narrows perspective. When you desperately want a trade to win, you begin justifying poor decisions. You may move your stop-loss further away to avoid being wrong. You may close a trade too early to lock in small profit because you fear losing it. You may avoid taking the next valid setup because the previous one lost. All these reactions stem from assigning too much importance to individual outcomes. Detachment does not mean indifference. It means understanding that long-term results matter more than short-term fluctuations. Managing losses properly is another core pillar of discipline. Losses are not personal failures. They are business expenses. Every business has operating costs. In trading, losses are the cost of participating in uncertain markets. Small losses are healthy. They protect capital by preventing large damage. When a trader accepts predefined risk and allows the stop-loss to execute, they are demonstrating control. When they try to avoid losses by moving stops or increasing risk, they often create larger losses that harm both the account and confidence. Avoiding small losses often leads to catastrophic ones. Many traders hold on to losing positions because they cannot emotionally accept being wrong. What begins as a manageable 1% loss can grow into 5% or 10%. This behavior is rarely about strategy, it is about ego and fear. Accepting a small loss quickly requires humility and discipline, but it preserves long-term survival. Survival is the foundation of success in trading. Drawdown control is not just about protecting money, it is about protecting mental capital. Mental capital refers to clarity, confidence, and emotional stability. When a trader experiences multiple losses in a short period, frustration builds. Decision-making becomes reactive rather than rational. This is why setting a maximum daily loss limit is critical. If that limit is reached, trading stops for the day. No exceptions. This rule prevents emotional spirals. It creates space to reset mentally and review performance objectively. Continuing to trade while emotionally disturbed often leads to revenge trading and further losses. Protecting mental capital ensures longevity. Even if financial damage is small, emotional damage can distort behavior for days or weeks. Taking structured breaks after drawdowns helps maintain stability. Discipline is not about forcing more trades, it is about knowing when not to trade. Eliminating impulsive behavior requires practical structure. Discipline becomes easier when the environment supports it. Setting defined trading hours is one of the simplest yet most effective rules. Decide in advance when you will trade and when you will stop. Once the session ends, close the charts. Overexposure to the market increases temptation and fatigue. Professionals treat trading like scheduled work, not constant activity. If impulsive entries are a problem, removing one-click trading can help. Adding small friction between idea and execution creates time to think. When entering a trade requires deliberate steps, emotional impulses are less likely to convert into action. Keeping position size fixed is another powerful control tool. Variable position sizing based on emotion leads to inconsistency. Fixed risk per trade creates stability and predictability. A highly effective technique for reducing impulsive behavior is the pause rule. Before entering any trade, pause and ask 3 simple questions. Does this match my plan? Is my risk clearly defined? Am I calm? These questions create awareness. If a trade does not match predefined criteria, it should not be taken. If the stop, loss, and target are not defined before entry, the trade lacks structure. If you are emotionally agitated, angry after a loss, overly excited after a win, or anxious due to fear, you are not in an optimal state to execute. If any answer to these questions is no, the correct decision is to step away. The pause rule transforms trading from reactive to intentional. It interrupts emotional momentum and restores rational thinking. Over time, this habit strengthens discipline. Emotional control is not about suppressing feelings completely. It is about recognizing them without allowing them to dictate actions. Discipline develops through repetition. Every time you follow your rules, despite emotional discomfort, you reinforce professional behavior. Every time you accept a small loss calmly, you strengthen resilience. Every time you stop trading after reaching your limit, you protect both financial and mental capital. Emotional control does not eliminate uncertainty or losses, but it prevents temporary emotions from causing permanent damage. In the long run, the trader who masters their reactions gains a far greater edge than the trader who simply searches for better predictions. Strategic edge and market understanding begin with clarity, not complexity. Many traders overwhelm themselves with advanced concepts, dozens of indicators, and conflicting signals. They believe that more information equals more accuracy. In reality, sustainable success in trading comes from understanding a few core principles deeply and applying them consistently. The market is not random chaos, it moves in recognizable patterns. The key is learning to read those patterns in a simple, structured way without overcomplicating the chart. Market structure is the foundation of technical understanding. At its core, price moves in trends or ranges. A trend is defined by structure. In an uptrend, price forms higher highs and higher lows. Buyers are consistently willing to step in at higher prices, showing strength. In a downtrend, price forms lower lows and lower highs. Sellers are in control, pushing price downward with momentum. Recognizing this basic pattern immediately gives context. Instead of guessing direction, you align with what price is already communicating. Ranges occur when the market moves sideways between clear support and resistance levels. During these phases, neither buyers nor sellers dominate. Price bounces between boundaries, creating temporary equilibrium. Many traders lose money in ranges because they attempt to trade breakouts that never materialize. Understanding that the market is ranging allows a trader to either trade the boundaries carefully or wait patiently for a confirmed breakout. Breakouts happen when price moves beyond a defined structure level with strength. This usually indicates a shift in supply and demand. However, not all breakouts succeed. Some are false moves designed to trap early participants. This is where liquidity zones become important. Liquidity often rests above previous highs and below previous lows because many traders place stop losses there. Price may temporarily move into these areas to trigger stops before reversing. Recognizing liquidity zones helps explain why the market sometimes behaves unpredictably. It is not random, it is seeking orders. The goal is not to memorize advanced terminology, but to clearly identify these core structures. Higher highs and higher lows suggest upward momentum. Lower lows and lower highs suggest downward pressure. Ranges suggest patience. Breakouts suggest potential expansion. Liquidity zones explain sudden spikes and reversals. Keeping this understanding simple reduces confusion and builds confidence. Understanding market structure leads directly to the concept of edge. Many traders confuse edge with prediction. They believe having an edge means knowing exactly where the market will go next. This belief creates unrealistic expectations and emotional instability. An edge is not a guarantee. It is a repeatable condition where probability favors you over time. For example, entering in the direction of a confirmed trend after a pullback may statistically produce better outcomes than randomly entering trades. That statistical advantage is the edge. An edge does not guarantee that the next trade will win. It only guarantees that over a large sample of trades, the strategy should produce positive expectancy if executed consistently. This distinction is critical. When traders expect certainty, they react emotionally to losses. When they understand probability, they accept variance. The strength of an edge is revealed through repetition, not single outcomes. This is where backtesting becomes essential. Instead of assuming a strategy works, it must be tested objectively. Testing at least 100 trades provides meaningful data. During backtesting, measure win rate, average risk to reward ratio, and maximum drawdown. Win rate shows how often the setup succeeds. Risk to reward ratio shows how much is gained relative to what is risked. Drawdown reveals the worst losing streak or capital decline within the sample. Together, these metrics define the strategy's statistical profile. For example, a system with a 45% win rate might initially seem weak. However, if the average reward is twice the average risk, it can still be highly profitable. Backtesting removes emotional bias. It replaces opinions with numbers. Once the data confirms positive expectancy, the trader's job becomes execution, not constant modification. Changing strategies after a few losses often destroys a valid edge that simply requires patience. Simplifying your chart is another powerful step towards strengthening edge. Many traders overload their screens with moving averages, oscillators, volume indicators, divergence tools, and custom signals. Instead of clarity, they create noise. When indicators conflict, confusion increases. Confusion leads to hesitation or impulsive entries. Reducing indicators forces you to focus on price action itself. Price is the final authority. Indicators are derived from price, they lag behind it. Focusing on price action means observing structure, momentum, reaction at key levels, and behavior around liquidity zones. This approach encourages deeper understanding rather than blind reliance on signals. Analysis paralysis occurs when too much information prevents decisive action. A trader waits for perfect alignment of multiple indicators, and by the time everything agrees, the move is nearly over. Simplicity increases decisiveness. Complexity often hides insecurity. Traders sometimes add more tools because they lack confidence in their edge. They believe that if they just add one more confirmation, they can eliminate losses. But losses are part of probability. No amount of indicators can remove uncertainty. True confidence comes from tested data and consistent execution, not from visual complexity. A clean chart promotes mental clarity. When structure is obvious, decisions become straightforward. Either the setup matches your criteria, or it does not. Either the trend is intact, or it is broken. Either price is in a high probability zone, or it is not. This binary clarity reduces emotional negotiation. Strategic edge and market understanding are not about predicting every move. They are about identifying repeatable patterns within structure and applying disciplined risk management. When you understand how trends form, how ranges behave, how breakouts expand, and where liquidity rests, you gain context. When you define edge as probability rather than certainty, you remove unrealistic expectations. When you backtest thoroughly, you replace hope with evidence. And when you simplify your chart, you strengthen focus and confidence. In trading, clarity creates consistency, and consistency allows edge to express itself over time. Transitioning from an emotional trader to a consistent trader is not a sudden transformation. It is a gradual identity shift built on evidence, structure, and self-control. Many traders believe confidence comes from winning streaks. After 3 or 4 profitable trades, they feel unstoppable. But that type of confidence is fragile. The moment losses appear, it disappears. Real confidence is not built on temporary results. It is built on proof. It comes from backtested data that shows your strategy has positive expectancy. It comes from controlled risk that protects you during losing streaks. It comes from repetition, executing the same setup over and over until it becomes second nature. And it comes from experience, not excitement. When you know that your system has been tested over at least 100 trades and has shown profitability, you stop reacting emotionally to individual outcomes. You understand that a loss is part of the distribution. When you consistently risk a fixed percentage per trade, such as 1% or less, you remove the fear of catastrophic damage. When you execute your setup repeatedly without changing rules based on mood, you create stability. Confidence formed this way is calm and quiet. It does not depend on daily profit. It depends on process. To move from emotion to consistency, you need a structured growth plan. Growth in trading is not accidental, it is intentional. One of the most powerful habits is conducting a monthly performance review. Instead of judging yourself daily, analyze results every 30 days. Review total trades taken, win rate, average risk to reward, rule adherence, and emotional behavior. Look for patterns. Did you follow your plan consistently? Did you break rules during specific conditions? Data reveals truth more clearly than memory. Adjustments should always be based on data, not frustration. If backtesting and forward testing show weakness in a setup, refine it logically. But if results are within expected statistical variance, avoid unnecessary changes. Many traders sabotage themselves by modifying strategies after normal drawdowns. Consistency requires patience. The focus during growth should be improving execution quality, not chasing higher profits. Profit is an outcome of strong execution. When execution improves, profits follow naturally. The journey of development can be divided into 3 stages: survive, stabilize, and scale. The survival stage is about protecting capital. At this stage, the primary objective is to avoid large drawdowns. You are learning discipline, enforcing risk limits, and building emotional awareness. Profit is secondary. If you can trade for several months without blowing the account, you are succeeding in survival. The stabilization stage comes next. Here, results become more consistent. Losses are controlled. Risk is steady. You begin to see steady performance over multiple months. Emotional reactions decrease because you trust your process. You are no longer experimenting constantly. You are refining and reinforcing. Scaling is the final stage, and it must be approached carefully. Scaling too early destroys progress. Risk should only be increased when strict conditions are met. You should have at least 3 consecutive profitable months. Your trading journal should show consistent rule adherence. Drawdowns should be controlled and within expected limits. If profitability came from a lucky streak or rule breaking, it is not a stable foundation for scaling. When increasing risk, it must be gradual. Moving from 1% risk per trade to 5% immediately is reckless. Instead, increase from 1% to 1.25%, then to 1 to 1.5%. Small increments allow you to adapt psychologically. Larger position sizes create stronger emotional reactions. Gradual scaling ensures that discipline remains intact. If emotional control weakens at a higher risk level, reduce size again. There is no shame in stepping back. Protecting consistency is more important than accelerating growth. Scaling should feel controlled, not exciting. If increasing size creates adrenaline or fear, the jump may be too large. Sustainable growth in trading mirrors compound interest. Slow, steady increases produce exponential results over time. Aggressive jumps often lead to aggressive drawdowns. Ultimately, the transformation from emotional trader to consistent trader is an identity shift. It is not about finding better tools, smarter indicators, or secret strategies. It is about who you become in front of the chart. The emotional trader reacts. They chase opportunities, fear losses, and measure success by individual outcomes. The consistent trader executes. They follow predefined rules, accept losses calmly, and measure success by process adherence. Intelligence alone does not create profitability. Access to advanced tools does not guarantee discipline. Luck may produce temporary gains, but it cannot sustain them. Identity determines behavior. When you begin to see yourself as a disciplined operator rather than a hopeful participant, your actions align differently. You wait patiently. You respect risk. You stop negotiating with your rules. When you stop chasing outcomes and start respecting process, something powerful happens. Pressure decreases. Emotional swings soften. Decision-making becomes clearer. Profitability begins to emerge as a byproduct of consistency rather than a target you are forcing. The market stops feeling like an opponent and starts functioning as an environment where your structured edge can operate. That is the moment the transition is complete, not when you win more trades, but when you no longer need to win to feel in control.